How are crypto assets like your Bitcoin or Ethereum taxed? In order to understand this question, we need to get some context and take a short journey through time. Many moons ago, man produced goods and services just like we do today, and as a way of exchanging these, they would barter with each other. Pigs traded for cows, wheat for shoes, vegetables for meat, the double coincidence of wants in full action. An inefficient and clunky system to us today, perhaps. And then came the early coins produced in China, a way of trading more efficiently. These developed, evolved, and real gold and silver were contained in some of these coins, giving them intrinsic value. And then man transitioned to paper as promissory notes for the gold, silver, and coins man held. Bretton Woods in 1944 and the beginning of the end of this gold standard in 1971, when President Nixon of the United States of America effectively took the US dollar to a pure fiat currency system, with all other major currencies following closely behind. And then, in 2008, the birth of a new supernova known to us all today as crypto. Crypto assets' rise in popularity has been nothing short of meteoric, considering that in recent memory this asset class would have been valued at, well, just above zero. The current approximate $2 trillion global crypto market cap shows just how far we have come in such a short space of time. And it seems as though this class of asset is here to stay. In short, a crypto asset is a form of digital money that is decentralized, meaning no central bank like the Fed in the USA or Bank of England in the UK has any control over it like they do with fiat currency. That is the US dollars, Great British pounds, and other government-backed currency that you hold. Crypto assets amongst others include cryptocurrency like Bitcoin or Ethereum, tokens like Shiba Inu, non-fungible tokens, and stablecoins. In 2009, an individual who goes by the pseudonym Satoshi Nakamoto created Bitcoin, the first decentralized digital currency with a secure framework called the blockchain. Bitcoin, Ethereum, Litecoin, Cardano, Dogecoin, the crypto world continues to expand seemingly faster than our universe, and it shows no signs of slowing down. Crypto assets have predominantly been used as a personal investment to date, almost replacing gold and silver as a hedge against government-backed currencies. But the $64 trillion question is, will this form of digital money become the standard medium of exchange? A new monetary system to eventually replace the US dollar, Great British pound, Indian rupee, and other government-controlled fiat currencies across the globe. Only time will tell. This is surely an evolution, or are we in the midst of a revolution? To date, many of the early adopters and investors in crypto assets have fared quite handsomely, making significant paper and actual profits on their speculative investments. Even today, Bitcoin and other crypto assets are still being invested in. Money is being made, money is being lost, just like investing in and trading stocks, shares, property, and other traditional assets. Is it just another big speculative casino? And then the taxman cometh to do what the taxman does. Thank you for watching my intro. I sincerely hope you enjoyed that. And if you did like it, please, if you don't mind, do hit that like button because it helps me to create more content, quality content like this, and also helps me to continue to educate you in taxes. Crypto asset holders and investors probably don't really want to think about the crypto taxes implications too much, but tax agencies such as the IRS in the USA and HMRC here in my home country, that is the United Kingdom, are zoning in on this lucrative asset class. They are beginning to beef up their operations and resources for what they see is low-hanging fruit. So I urge you, don't ignore this because it will rear its head if you invest, hold or trade this particular asset. So crypto is actually classified as property by tax authorities in most countries, including the USA and here in my home country, the United Kingdom. And for tax purposes, property is an asset. So think about a tangible residential property, a buy-to-let investment, not your own residential home. And in accounting and tax language, you have perhaps your closest comparison to crypto assets. So invariably, in most cases, there are two two forms of taxation that could apply to crypto assets, depending on the activity and of course activities that are undertaken, and that would be capital gains tax or income tax. Firstly, in the vast majority of cases today, and certainly from my experience, I mean, most of you individuals probably hold or held crypto assets as a personal investment with the aim of its value going up, or capital depreciation. You do similar to shares and stocks and property. And in simple terms, if this is the case and you sell or dispose any part of your crypto asset at a gain, that is a profit, you will be potentially liable to pay capital gains tax, whether you are based in the US, UK, and more than likely in most countries around the world. Now, I've emphasized the word disposal as this is key. You see, capital gains tax is not only triggered in the event you sell your crypto asset in exchange for fiat currency, but the definition of a disposal is a lot broader than this in tax terms. So stay tuned and I'll explain this in more detail very shortly. And secondly, I know this is quite rare at the moment, if not probably non-existent, but I do believe that this is going to start happening more and more in the future. And that is, if you receive any form of cryptocurrency from your employer as a form of payment, then it would be subject to employment taxes, that is income taxes. So here in the UK, this would be PAYE, pay as you earn income, and Class 1 national insurance. Absolutely no different to if you were being paid in Great British pounds sterling. But the added complexity in this particular situation is that if you receive, let's say, 2 Ethereum in exchange for 1 month's pay, then this could also be subject to capital gains tax if you were to later dispose of the Ethereum at a gain, i.e. profit, later on in time. And lastly, in some instances, crypto assets could fall under income tax rules. So for example, an event called an airdrop is when you receive some crypto assets for free via an exchange, perhaps for marketing or promotional reasons. What exactly is a capital gains tax? So as the name suggests, capital gains tax, CGT, is a tax on capital gains. Simply put, you invest in Bitcoin for 10 and sell it for 100, you have made a gain of 90, also known as a profit. But capital is wealth in the form of money or property that is used to make more wealth, and a gain is an increase in that value of that wealth. It's a very common class of taxation across the world, including the USA, Canada, Australia, and so on. A CGT liability may arise when a chargeable person makes a chargeable disposal of a chargeable asset. Here's me in a video about capital gains tax in a bit more detail, which you can watch by clicking on the link in the description box below. So what is actually considered a chargeable disposal for crypto assets? And here's a list that is provided by both the IRS in the USA and HMRC in my home country here in the United Kingdom. Number 1 is selling crypto for fiat currency. Number 2 is swapping crypto for crypto, so where a gain has actually been made. So for example, if you swap your Bitcoin for an Ethereum, where you originally bought the Bitcoin for say 100, and at the point you swap it, it's valued at 500, this will trigger a capital gains tax liability. Number 3 is spending crypto on goods and services. So this may come as a bit of a surprise to some of you, but in principle, this is no different from swapping one crypto for another. You're effectively exchanging your crypto for goods and services, so therefore it will trigger or could potentially trigger a capital tax liability. And finally, gifting crypto. So this kind of rule varies from country to country, but here in the United Kingdom, excluding your spouse or civil partner, this is actually considered a deemed chargeable event. And the word deemed just meaning based on as if the person gifting crypto to you has been paid for it, but obviously it's a gift. But don't forget, a chargeable disposal also applies to events where you make a loss. So if your crypto assets has devalued and you happen to do one of these, you can register the loss, which could be invaluable to you, as losses can be stored and used to lower your future tax bills by possibly 20% or maybe even 40%. But how? I've done an in-depth course that shows you this, which you can access in the link below. But if you find yourself in a decent situation where the value of your crypto is greater than what you paid for it, then it is likely you will be sitting on paper gains, and that's actually not a bad problem to have. What I want to help you understand is broadly how a capital gains tax would be calculated in this particular scenario. Now, this situation itself does not trigger a capital gains for tax. Just because there is an appreciation of your crypto does not mean you are liable to CGT crypto taxes. Remember, it's only when a chargeable disposal takes place. But how much tax do you actually have to pay? Essentially, it's the difference between the sale proceeds and what is known as the base cost. Base cost is essentially what you paid to buy the crypto asset with your fiat currency, that is either US dollars, British pounds, or whichever is your local currency, and you add in any transaction fees like a platform broker fee, normally a percentage of the purchase costs. So if you bought a Bitcoin for $10,000 and you use Coinbase, for example, as an exchange, who charge $200 in buyer fees, then your base cost is essentially $10,200. If you have multiple crypto assets, then in the tax world, there is a method called shared pooling. And this is something I explain in more detail in my course. So let's say there's been a chargeable disposal of your crypto asset that you originally bought for $10,000, and you dispose of it for $25,000. Your gain subject to capital gains tax is $14,800, which is a $25,000 less the $10,000 acquisition costs, less the $200 fees that you paid. Depending on where you are a tax resident, you may get a capital gains tax allowance amount, like here in the United Kingdom, which is currently £12,300 per UK individual tax resident per year. The thing is, just knowing about which taxes apply to crypto assets is helpful, but alone is not enough to help you effectively mitigate your taxes. There is actually a few more things you need to learn and combine it with if you really want to legally reduce your tax bill, starting with this video on capital gains tax. So don't ignore this, and you can build upon what you've already learned to 10x your knowledge power and slash your taxes. Of course, legally.